U.S. manufacturing is in steep decline, and the proof is in the oil markets. What's up, guys? I'm nobody special, and we got a whole bunch of economic data over the last few days. We got some PMIs and some manufacturing indexes from various organizations around the country, and it all says the same thing. Manufacturing in the United States is in free fall, and the data in the oil market is supporting that as oil inventory continues to build up in the tanks in the United States with week after week of massive inventory builds in oil. And with that, we are going to shrink my big melon of a head, and let's take a look at some of these reports that just came out today. First one up is the Richmond Fed Manufacturing Index, and this one is a doozy. It came in today at negative 16. Anything below zero is considered manufacturing in contraction. And you can see going all the way back to May of last year, with only a couple of exceptions, manufacturing has been consistently in decline. Reading a little bit from this report, the Manufacturing Activity Index in the Richmond area decreased to minus 16 in February of 2023 from minus 11 in the previous month, the lowest since May of 2020. Of its three-component index, shipments and employment declined while new orders index remained unchanged at negative 24. And remember the way these indexes work, if it's below zero, it's in decline. So 2 consecutive months of minus 24, that is continued decline. So this month's 24 is lower than last month's 24. These are rates of change. Firms remain pessimistic about local business conditions as the index remained at negative 13. However, the expectations index for local business conditions increased notably and returned to positive territory for the first time since March of 2022. Businesses continue to see declines in backlogs and lead times as both indexes remain negative. So they're working through the backlogs and there's not enough new orders to come in to replace them. However, the capacity utilization index fell notably from minus 7 in January to minus 17 in February. Well, that means production capacity is starting to go idle. The average growth rate of prices paid remains nearly unchanged, while the average growth rate of prices received decreased in February. That's margins being compressed. Firms expect both to moderate over the next 12 months. And when you fly halfway across the country over to the Dallas Fed Manufacturing Index, you get a very similar picture. This one came in at negative 13.5. And again, anything below zero is in contraction. And this one has been in contraction territory since May of last year. Negative numbers across the board. And reading from this one, the Federal Reserve Bank of Dallas General Business Activity Index for manufacturing in Texas slipped 5.1 points to negative 13.5 in February of 2023 from negative 8.4 the previous month. It marks the 10th consecutive month of contraction in activity. New orders index was negative for a 9th month in a row and moved down 9 points to negative 13.2. And the production index, a key measure of state manufacturing conditions, edged down from 0.2 to negative 2.8, a reading suggestive of a modest contraction in output. Also, the capacity utilization index returned to negative territory after 2 positive readings, falling 10 points to negative 4.1. Labor market measures suggest relatively flat employment and longer work weeks. On the price front, price and wage pressures intensified in February. Lastly, the Future Production Index pushed further positive to 21.3, signaling output growth is expected in the next 6 months. The Future General Business Activity Index was slightly negative, moving up from negative 9.1 to negative 2.9. So again, we're seeing the same thing in Dallas. Several consecutive months of declines in manufacturing activity, and yet for some reason, at least some of these businesses remain at least modestly optimistic about future prospects. But we're seeing new orders are slowing, backlogs are shrinking, lead times are shrinking, and idle capacity is starting to build up at these facilities. Now let's head north to Chicago with the Chicago PMI. This is the Purchasing Managers Index. This came out just today. Now, this one is a little different. Anything below 50 represents contraction in the Chicago PMI. Anything above 50 represents expansion. And you can see here the Chicago PMI has been in contraction territory since September of last year. And reading from this report, the Chicago PMI in the United States fell for a second consecutive month to 43.6 in February of 2023 from 44.3 in January. Figures came lower than market forecasts of 45, pointing to another contraction in economic activity in the Chicago region, which extended for a 6th straight month. So we've got contractions in economic activity in Chicago, contractions in Dallas, contractions in Richmond. Kind of flies in the face of this economy that's supposed to be strong as all get out. So who do we believe? Do we believe the jobs report that shows millions and millions of jobs being added? Do we believe the politicians who tell you the economy is strong? Do we believe the talking heads on CNBC who are talking about the strength of the American consumer? Well, I like to go right to the source, and that is oil, because you can make the statistics say anything you want them to say by fudging the numbers, but you cannot fake the burning of millions of barrels of oil. And check this one out. Came out just today. This is the American Petroleum Institute. These are private sector numbers of oil inventories in the U.S. And right here, this latest data point hit the tape just a few minutes ago. Another massive oil inventory build in the United States last week. This time, 6.2 million barrels. And you can see with just one exception, oil inventory has been rising by several million barrels every week since the start of the year. And keep in mind, in December, we stopped the dumping of the Strategic Petroleum Reserve. That was almost 7 million barrels of oil a week that we were dumping from the SPR. When that supply went away, you would think these inventory numbers would have started shrinking. But the opposite has happened. We stopped dumping the SPR, and yet all of a sudden the inventory is rising. We're just not burning that much oil. Since the start of the year, the API crude inventory has averaged a 7.1 million barrel per week increase. Stocks of crude oil in the United States jumped by 6.203 million barrels in the week ended February 24th, 2023, following a 9.9 million barrel gain in the previous week. Data from the American Petroleum Institute shows it came above market expectations of a 0.44 million barrel increase. So we are just not using oil. And it's not just the API numbers that are showing this, folks. These are the Energy Information Administration numbers. This is the government's numbers now. Now, this week's data point from the EIA hasn't come out yet, but if you go by the most recent data, you get a very similar picture. Last week, we built by 7.648 million barrels, and actually the EIA numbers have averaged an even bigger increase since the start of the year, averaging an 8.3 million barrel per week inventory build. Now, any one of these data points in isolation wouldn't be so worrying. These charts are known to bounce up and down. There's week-to-week fluctuations, but that's not what we're seeing here. We're seeing month after month consistent declines in manufacturing activity, not in just one region, several regions from across the country. Chicago, Richmond, Dallas, all showing major declines in manufacturing activity. And we've seen the same thing with the New York Fed and the Philly Fed and all the other Feds around the country. American manufacturing is slowing. It's been slowing for several months, and the pace of that slowing is increasing. And you can get confirmation of that trend with these oil inventory statistics, where week after week, several million barrels of oil have been building up in inventory since January. And again, you have to factor in that with the end of the dumping of the SPR in December, we should be seeing those inventories contracting right now. Instead, they're building. Something is going on in American industry right now. It is slowing substantially, and you're not hearing about it in the mainstream financial press. They're too busy talking about the fact that 500,000 people got temporary jobs as baristas last month, and that's somehow indicative of the strength of the economy, or because millennials and Gen Zers went on a shopping spree in January and bought a bunch of stuff and put it on the credit card instead of paying their auto loans, that somehow this is a strong economy. But the manufacturing numbers paint a different picture, and the oil numbers paint a different picture. The U.S. industrial output is slowing rapidly, and by the time you hear about it in the mainstream financial press, it will already be too late. Till next time, live small and dream big.